So before to move towards the specific rule, the specific policy for the risk management in agriculture, we just resume the what are the um, specific objective of the actual programmation of the CAP. So for the 2023-2027, the Common Agricultural Policy is structured around 9 specific objectives that cover, as we emphasized before, environmental and economics dimension, social also, moving beyond the 5 core aims of the treaty overall. These 9 key objectives are the basis upon which individual EU country design their national strategic plan. So, concerning the public support framework for risk management inside the Common Agricultural Policy, as we introduced it before, we have for the first time within the Rural Development Programs Pillar 2, a set of rules which disciplines the public support at risk management tools. The main publicly supported risk management tools available to member states include subsidization for crop insurance, so that member state can provide financial contribution, subsidy for the premium, to cover a portion of the premium paid by farmers for insurance policy. This insurance protects against economic losses caused by adverse climatic events such as hail, frost, drought, flooding, animal or plant disease and pest infestation, and for losses to farm structure or assets, building damages, carcass disposal, and so on. But we have also at the Article 38 the mutual funds possibility, so the CAP supports the establishment and the administration of mutual funds. So these funds allow a group of farmers to pool risk and create financial reserve through contribution. Member states can then withdraw funds for the second pillar of the CAP in a way to finances this kind of tool. The very big challenges and news in terms of tools is represented by the income stabilization tool that has been foreseen in the second pillar or the previous program of the CAP at the Article 39, the AST, which is a tool that has been designed to provide a basis coverage against significant income crisis. So differently from the mutual fund, the income stabilization tool look at just at the income crisis. So this kind of tool aiming to protect the revenue of the farmers against the volatility of their income. This is due through market fluctuation or climate events. So, just to point out in very few words what the risk management proposal for the previous programming of the CAP introduced. So, recalling what we introduced also in the part 1 of this model about risk management strategy and classification, we're trying to explain how different tools work linked to several risks that we introduced before. So dependently from the nature of the risk, for example, if we look at systemic risk or frequency, catastrophic, and so on, we will analyze the capability of each tool to match this single kind of risk, this single typology of risk. So risk management is the process of identifying, analyzing, and reducing risk to decrease losses. So the following types of risk that affect farmers' activity, with climate influences in many cases amplifying all three categories that we identified. So we talked about, at this stage, the possibility that the CAP would offer a different range of mechanisms for farmers to manage their risk, including, as specified before, crop insurance, mutual funds, and income stabilization tool. Each measure addresses different aspects of risk and is financed through public and private research under the guidance of member state strategic plan. So, concerning the insurance premium subsidy, we know that under Pillar 2, this kind of tools protect farmers against crop and livestock losses caused by adverse events. We know that mutual fund and income stabilization tool address income shocks faced by farms due to production or market risk. They are often organized at cooperative or sectoral level, but can also involve a national structure. And then we have also public funds for disaster compensation. So in addition to these two that are foreseen in the second pillar since the programmation of the CAP in 2014-2020, member state can allocate public fund specifically for disaster compensation. This is, for example, the choice that Italy carried on for the previous period of the programmation of the CAP. So, the support framework for risk management in EU, just to summarize, we see before that since 2008, so by the introduction of the health check of the CAP, we have the first recognizing inside the CAP structure of the how support risk management tools in agriculture for EU farmers. For the first time in the 2014-2020, we have inside the Pillar 2 of the CAP a specific rule aimed to define the public support for this kind of risk management tools, specifically crop insurance, mutual funds, and income stabilization tool. So, concerning the implementation of this kind of possibility that has been offered at member state level of CAP structure for the first time 2008-2013, we have that just 9 countries adopt an ex-ante intervention: Italy, Belgium, France, and so on. Many countries doesn't support crop insurance. Many countries have natural disaster exposed assistance, and just few country utilize exposed just for disease. The omnibus that were the a sort of midterm review for the program of the CAP in 2014-2020, forcing the eventuality to capitalization of mutual fund and income stabilization tool in ex-ante capitalization, and lower the ceiling of the single tools. So crop insurance have a ceiling of 20% instead of 30%, and increase the contribution, the public contribution to the public participation in the subsidization of each tool. So from 65% to increase to up to 70% for insurance with the premium, for crop insurance, and for the capitalization for mutual fund and income stabilization tool. So we already talked about the concern of the consequences of natural disaster on agricultural productivity. In this sense, we have some estimate. We already have some estimate in aggregate EU losses that vary across climate periods: drought, excess precipitation, hail, frost. All these kind of events, approximately 80% of the overall agricultural losses across the EU. Of these perils, drought is the worst, causing across the EU almost 10 billion of euro in terms of damages. Excess rainfall generates the next largest losses, totaling around 3.2 billion of euro, with frost and hail together contributing a similar amount. By 2050, the overall damages derived from climate change trend is expected to rise 42.6% increase in annual average crop losses, depending on the emission scenario. So the question of the annual average losses generated but from the catastrophic climatic events is a very, very tough task for the economics resilience for EU farmers in the future. So in details, just have a look at the single perils that we mentioned before. The drought of 2022 decreased the maize yield by 24% across Europe compared to previous year. Spain bore the largest proportion of the losses with other countries, including France, Italy, and Romania, that has been severely affected. Since 1960, average soil moisture, an important drought indicator, has dropped in most of Europe and increased the need for artificial irrigation. For Central European countries, the upper soil layer of 0.7 centimeters experienced a drop about 3-4% on average, while most of the Iberian Peninsula lost 5 to 15% of its moisture. The Kirschbaum Drug Index assesses drought condition and wildfire risk using multiple meteorological factors, including maximum temperature and precipitation. And we, we can see in the figure, by 2050, the most severe increase in drought risk is expected. Spain, in Italy, in Greece, so in the Mediterranean basin, with more than 9 times as many days of severe drought condition each year. So current crop average annual losses from drought exceed 3% of EU crop yield and are valued at almost 10 billion euro. So the largest agricultural producer, so Spain, Italy, France, Romania, and Germany, have an annual average losses in excess of 1 million euro. By 2050, we will increase these annual average losses up to 45%. Concerning frost risk dynamics present a complex pattern across the EU and perhaps counterintuitively show significantly growing losses despite warming trends. Because frost poses significant threats to high value crops such as viticulture, fruit, vegetables, which are highly sensitive and vulnerable during flowering and shortly after budding. In 2017, a single frost in mid-April led to 24% and 12% less apple and pear production respectively in Europe. So the total losses were 3.3 billion euro with approximately 600 million euro insured. Italy and France were estimated to have the highest loss at approximately 1 billion euro. So under current climate condition in Europe, there is already significant exposure to late frost. So the time period between March and May. This is the most perilous period during the year where we have the fruit, vegetables, and the viticulture crops that are very, very sensitive during its flowering. In 2021, sequence of severe late spring frost led to 50-70 less production for some crops. And in France, the late spring frost affected also olive groves, causing a 25-30% in reduction for the production. So climate change is creating additional exposure to crops even earlier in the growing cycle, as biological spring tends to arrive earlier than in the past. So frost day, however, have not shifted in the same way. So the average number of frost days during the early growing stage was 0.51 day in Central Europe 50 years ago. This has increased to nearly 3 frost days now. In France, the average annual frost days in growing periods has doubled, approaching 5 some regions. Frost days in Spain are moved regionally, decreasing in central and southern Spain while increasing in northern Spain. Future frost loss trends across the EU will be different. Climate models suggest that number of frost days during the growing season will increase up to 2050, especially in France, Belgium, the Netherlands, and central Spain, with up to 4 additional frost days compared to 90-90, as we can see in the future. However, in the east, so in Poland, Czechia, and parts of Italy, the number of frost days may decline. So the coastal parts of Spain and western France will also experience up to 3 less frost days. Concerning hail, although hailstorms are usually just a few kilometers wide, they can cause severe impact to high-value crops such as wine. For example, 1/3 of production was lost in Bordeaux region of France in 2018 from a hailstorm in May, which damaged over 13,000 hectares of wine, with approximately half entirely destroyed. So the climate change scenario assumes global greenhouse gas emission peak around 2040 and then decline, aiming for radiative forcing to stabilize at 4.5 watts per square meters by 2100. And in this scenario, the frequency of heavy hail events is expected to increase by 15-20% for large area in the Mediterranean and South Central Europe, including area in southern Germany, Austria, Croatia, Serbia, and Romania, how you can see in the figure. So also the hail will be a very, very challenging task for the insurance company due to the increase in size of the hail and due also the extension of the hail in a wider sense respect than in the past. So in addition to damaging the quality and yield of the crops, another question concerning the excess rainfall that can increase the spread of pest and disease, for example, damaging higher value crops such as fruit and wine. Related flood risk vary also depending on the landscape and hydrology of the single region in the EU, making modeling of localized and aggregated impact challenging for policymaker and researcher. So, recalling what we introduced in part 1 about risk management strategy and classification, we go forward trying to explain how different tools work linked to several risks above introduced. So risk management is the process of identifying, analyzing, reducing risk to decrease its losses. We talk about the possibility of the CAP to offer a different range of mechanisms for farmers to manage their risk, of course including insurance, crop insurance, mutual fund. But we have also the question related to the contingent capital. So all insurance systems provide shared pools of capital available to the portfolio under agreed conditions when defined events occur. We have also the question linked to the governance. So the insurance contract and the risk pools define rule for members, in our case the farmers that are there to the crop insurance contract, to join and access shared reserves. This may include the condition to reduce financial risk to the pool, such as climate adaptation intervention or defined uses and protocols for payout. There is a question for the solvency of the system. So the risk pool, including insurance company, manage contingent liability, so the potential payout, with funds available in the pool, known as capital reserves. There is a question linked to the solidarity. So the annual cost of membership are driven by risk-based costs of a member's protection, which provide incentive for risk reduction. This the question linked to the pool purpose. Most insurance is arranged because governments seek to limit their own liability or the liability of the citizens to each other. The risk layering, generally the primary risk owners old to low layer, smaller, more frequent risk and transfer higher layer risk. For agriculture insurance, it typically starts with the farmer, then the insurer, reinsurer, and finally government or possibly multinational coverage. To evaluate the effectiveness of insurance system within weather-related agricultural risk management, we could carry out risk layering. This apply the risk quantification techniques used currently from insurance company and government public institution, where events fall into three classification. Low severity, these occur frequently causing attritional losses. As we see before, medium severity, these occur less often but cause serious damages for farmers in our case, and the high severity that occur rarely but have devastating impacts, such as major natural disaster or large-scale economic crisis occur. And these risks are typically addressed through risk transfer mechanisms such as reinsurance or government disaster reliefs exposed. So, concerning the risk strategy, as pointed out before, risk is the exposure and vulnerability, those events which risk layering framework manager according to the three principles: risk retention, risk transfer, and residual risk. So when we talk about risk retention, we are looking at the small, relatively frequent losses that farmers absorb within their own budgets. And by improving farmers' awareness of how climate change may impact their operation revenue streams, public initiative can empower them to make informed decisions and strengthen long-term sustainability. When we look at the risk transfer strategy, we are referring to the process of shifting the financial burden of a defined loss event from one party to another. So this kind of strategy typically involves insurance-based solution, but can also include public support mechanisms such as government payments and so on. If you look at the residual risk, we are referring to the financial exposure resulting from the extreme events, so catastrophic losses that exceed the coverage limits of the private and public sector risk management tools. So these events are typically rare but have very severe consequences, leaving affected farmers without sufficient financial protection. In such case, public sector is the payer of last resort, providing post-disaster relief to support recovery. So this is the picture that reassumes this kind of question, where we have the scope of the risk, the level of the risk, the financing shared by public and private sector, and hiring in the scale to down from up, passing from normal risk to marketable risk to catastrophic risk. So, going to the last part of this module, we're talking about the public intervention in the EU. So, we have in the European Union basically 3 countries that are historically involved in public participation to support risk management tools aimed to manage risk in agriculture. And these countries are undoubtedly Spain, Italy, and France. Probably due mainly to crop specialization, these countries experienced since several decades with national resource public participation in support to risk management policies. And in the following part of this module, we will illustrate in details how these countries support crop insurance and, more generally, public intervention in ex-post support, and what are the most critical weaknesses and what are the perspectives for each countries that we are considering. So in Spain, established in 1978, Spanish agricultural insurance system is one of the most developed in the world and the most comprehensive in the European Union. So the system is a public-private partnership integrating government oversight and administration, public subsidy, and guarantees wide private insurance expertise and distribution, and active farmers input drug association. Its 3 main components are the Entidad Estatal de Seguros Agrarios, INESA, Agroseguro, and the Consorcio de Compensación de Seguros. Agroseguro is the operational hub that manages insurance policy design, the pricing, the condition of the crop insurance, the risk assessment, and the claims protocols. Agroseguro operates through a consortium of 16 private insurance companies that distribute this policy and collectively underwrite risk to crops, livestock, aquaculture, and forestry within the Agroseguro system. The premiums and claims are pooled with individual insurance, sharing liability proportional to their participation, and also Agroseguro conducts actuarial studies, adjusts premiums, and maintains reserve for high claim years. So the CSCS is the government-backed reinsurer for natural catastrophes across the Spanish insurance sector and provide protection for extreme agricultural losses that exceed Agroseguro's own capacity. The consortium is mandated to enable general insurance market solvency for natural catastrophes and operates beyond the agricultural sector alone. So the consortium is mainly funded through mandatory surcharge on general insurance policy, but in the case of agriculture, no reinsurance surcharge is applied to farmers. So Agroseguro is the policyholder and pay the full reinsurance premium to the consortium. The consortium also assumes the percentage of a co-insurance not covered by the insurance company and controls the adjustment of declared losses. So the Spanish General Directorate for Insurance and Pension Funds is mainly in charge of approving the percentage of insurance distribution among the company included in the agroseguro. So the Spanish model suggests is rooted in strong public-private coordination, adaptable policy design, and the high farmer trust. So agroseguro's ongoing refinement of insurance products and its response to emerging risk maintained its relevance and effectiveness. So this is a table that try to resume what we introduced before on the characteristic of the public intervention in Spain. We have the peril insurance, hail, drought, frost, and so on. The crop insurance, we have 29 crop insurance, including cereals, fruit, viticulture, 12 for livestock production, 3 for aquaculture production, and 1 for forestry production. This kind of insurance is not compulsory for Spanish farmers, and the overall insurance penetration is around 50%, with significant variation between crops and region. The loss ratio in average is above 100% in recent years, and this is one of the big tasks that the Spanish system needs to tackle in the future due to recent trend of climatic condition. In terms of percentage of premium subsidized by the public intervention, approximately 50% is subsidized by the member states, and public sector provide premium subsidy to the producers and their insurance protection to agroseguro risk pool. So this is a very schematic of Spanish agriculture insurance system that we already depicted before. Just to point out some exceptional season, for example, in 2017 we have a very severe losses due to the drought, and Agroseguro paid claims for 227 million, and state support stepped with emergency in irrigation works and the suspension of some fees. In 2022, Spain experienced very severe drought caused by a shortage of rainfall from the beginning of the October 2021 until mid-June 22. So this led to a period of water scarcity, particularly in the river basin of the south and the northeast of the peninsula, that has been exacerbated by the rising temperature in May and exceptionally high value in the summer. So in this case, Agroseguro paid 180 million euro to farmers for drought damages. Additionally, damage from frost in April 2022 led payouts from Agroseguro up to 259 million euro, and so on. So we have many years where the Spanish system have a loss ratio higher than 100%, so mean that indemnity claims from farmers were higher than the premiums that the insurance company collected from them. So what about to look in the future? The record for Spain, the record 2023 drew, we know, affected over 2.3 million of hectares, and 90% of which was identified as insured. So the overall national figure for agricultural losses, the 2023 draw are difficult to ascertain from published sources, but we have some evidence of reduced yields up to 50% in key crops such as cereals, olive and wine. The Andalusia government evaluated the cost of this drought in 2023 up to 4.2 billion euro. So just only in 23. So aggregate losses from drought, hail, rain and frost with a 2% annual probability of occurring are currently about 12.4 billion of euro. And we have a perspective for the future, an increase in 30% of average annual losses for Spain in terms of damages from extreme events. How you can see, we have this kind of aggregate losses from drought, hail. We say that we reach 12.4 billion of losses, but in looking at the future, these losses could increase up to 20 billion by 2050. So nothing news for what we introduced already before. So move to France. The first crop insurance company were founded during the previous century. Initially, the market was purely private, with coverage offered only on a named peril basis, such as hail, wind, fire, frost. And in 1964, a very high drought led to creation of a public compensation fund, the Fonds National de Garantie des Calamités Agricoles, through which the government could provide disaster financing to farmers. Multi-peril insurance coverage expanded in 2005 with the introduction of government subsidy of up to 65% of insurance premium, supported by the CAP funds. More private comprehensive insurance cover enabled charge to ex-post disaster payment in 2010, when a new national fund for risk management in agriculture, the Fonds National de Gestion des Risques en Agriculture, replaced the previous one. So this precluded claims to state disaster funds for losses resulting from privately insurable hazards. So new regulation in May 2022 extend the risk sharing between farmers, insurance and the government. This promoted the uptake of insurance by gradually removing support provided to uninsured farmers. So the system includes ex-post payment after catastrophic events to insured farmers as well as the uninsured farmers, but at a reduced rate. We have a multi-risk premium subsidy up to 70% funded through the CAP, European Agricultural Guarantee Fund. For the actual program of the CAP, 156 million euro are budgeted annually in France, steadily increasing in anticipation of more insurance penetration in the coming years. Premium subsidies are only available on policy meeting certain requirements, such as the breeded or peril-covered surfaces area under cultivation and the use of the 5-year Olympic yield as the baseline for losses. So, Tier 1 yield losses up to 20%, so the farmer, in this case, is entirely responsible for low intensity risk. Tier 2, when we look at yield losses above 20% and below 30-50%, depending on the crop. So for medium intensity risk, compensation is paid by the subsidized multi-peril crop insurance, or is a farmer's responsibility if they have not purchased insurance. And the Tier 3, when we have yield losses exceeding 30-50% of the harvest, depending on the crop. For exceptional risk, the national solidarity funds compensate the losses. So if the farmer is insured, the state compensates 90% of the Tier 3 losses, and the insurance cover the remaining 10%. If the farmer is uninsured, the state compensates 45% of those losses, with the rest borne by farmer. So, although policy conditions are heavily influenced by the subsidy eligibility requirement, private insurers are free to competitively price and sell multi-risk crop insurance and other named peril policy directly to farmers or producer groups. Compensation for uninsured farmers is planned to be reduced progressively from 45 in 25 by 5% each year to incentivize the uptake of insurance. It is too early to assess now if the new system incentive uptake of subsidized multi-peril crop insurance, but we have some number concerning the insurance penetration statistics from the Groupama that say that they received 14% more agricultural premiums in France in 2024, which indicates increased uptake. The major French reforms to its agricultural insurance were the first major realignment with the new CAP insurance support framework, and were followed by others, including Poland and Italy. So the French insurance market exhibits concentration, with Groupama holding a market share around 50%, and Crédit Agricole that is approximately reached 20% of the market share. Concerning the assessment of the agricultural insurance system in France, they experienced in 2017 unusually warm weather in March. That means vegetation was in growth stage when late spring frost it affecting viticulture and horticulture in France. Agricultural farmers faced losses around 1 billion of euro, and Groupama met approximately around 100 million claims, while the Fond National provided 18 million in compensation, suggesting a sizable protection gap despite the availability of public funds. This is one of the big questions for this country. So we have the availability of public funds, but we don't have a covering from the insurance market in a way to compensate the farmers' claims when unusual weather conditions come. In 2018, we have a very big hailstorm that impacted 17,000 hectares in Bordeaux, and we have damages up to 100 million euro in this case. Looking at the future, we have, of course, also for France, expectation in increasing for damages around 29%, rising from 10 billion for years expected to increase to 13 billions in 2050. And this means that each perils that we consider, so drought, frost, excess in rainfall, would affect the economics resilience of French farmers in the future. Lastly, we consider the public intervention in Italy, so the Italian system, that is an hybrid model integrating private insurance, subsidy and mutual funds to address several risks that Italian farmers face. So private insurance companies offer a range of policy, including single peril and multi-peril crop insurance, but only multi-peril insurance until last year was eligible for government subsidy. This is a shift that has been introduced in 2013 to encourage broader adoption of crop insurance between farmers. Subsidy funded through the CAP fund typically cover a range between 50–70% of the premium, even if in the last year this share of subsidy decreased due to increase in insurance tariff due to the climatic condition of the last decades. Despite that, only about 10% of Italy cultivated agricultural area and 9% of farmers were insured. So in overall, just about 20% of the gross value of the production in agriculture in Italy is currently insured. The very news introduced in 2022 is the AgriCat Fund, that is a fund that providing compulsory catastrophe coverage for farmers that receiving CAP direct payments. So AgriCats act as a safety net for higher frequency severe weather events such as frost, hail and drought, covering losses between 20 and 40% of historical yields. So differently from what happened in France. So losses above this are the purview of private insurance. This first three-layer approach aims to stabilize the insurance market and attract reinsurance market operator, but agriculture early performance faces several challenges. In 2023, it paid out just 26 million of euro of an expected 250 million, and uh, definitely had a limited, very limited impact on the overall insurance penetration. So the system covers in Italy multiple type of crops, including major staple and high-value crops such as olive and fruit. However, insurance penetration is concentrated in northern region, such as Lombardy, Veneto, and Emilia-Romagna, where commercial agriculture is more developed in terms of value. Insured value have grown steadily, reaching around 10 billion of euro in 2023, but as we said before, the total insurance land area has very stagnated and the number of insurance farms has declined throughout the years. So this trend highlights geographic and structural disparity in the system's reach. Extreme events have posed significant challenges to the system's sustainability. Catastrophic frost and ice storm in 2017, 2019, and 2023 resulted in substantial payout, straining insurance and raising premiums. For example, the 2023 frost severely impacted high-value crops such as fruit, exposing gaps in frost insurance coverage despite ongoing efforts to expand options. And such events have underscored the need for greater innovation in risk management tools. The broader insurance framework is complemented by mutual fund, introduced during the 2014-2020 CAP programming period. These funds provide cooperative-based protection against non-catastrophic risks such as pest infestation and plant disease, compensating members for losses exceeding 30% of historical income. Key agricultural regions, including Lombardy, Emilia-Romagna, Veneto, and Trentino, have been particularly active in promoting these funds, where farmers pool resources and share risk as an alternative to traditional insurance. Adoption nowadays remains limited due to administrative complexity and low awareness. Italy uses additional public funds such as the National Solidarity Funds to complement subsidy insurance. These funds provide ad hoc compensation for extraordinary risk or events not covered by standard insurance. And the aggregate fund supported by the CAP financing is a buffer for high-frequency catastrophic events, but there are concerns about its sustainability as mentioned above. In fact, in May 2023, devastating flood struck Emilia-Romagna, one of Italy's most important agricultural regions. Heavy rainfall led to widespread flooding, submerging over 5,000 farms and causing extensive damages to orchards, vineyards, and field crops. Agricultural losses were estimated to exceed 1.5 billion of euro. The flood also severely affected infrastructure, homes, and business, placing a significant financial burden on local community. Flood insurance coverage in Italy was low, with protection concentrated in the northern region, mainly for high value or high-risk crops. As a result, many farmers faced extensive costs for recovery. Condifesa Romagna, a non-profit association supporting agricultural risk management, provided 3.9 million in compensation to affected members. However, this amount of financial research covered only a small fraction of the total losses. In response to disaster, the European Commission allocated 1 billion of euro from its crisis fund, co-financed by the Italian government, to support agricultural business. Additional measures included 50 million euro from National Solidarity Fund to address damages in livestock sector, and so on. We have to emphasize also the 2024 drought in Sicily, where agricultural losses were estimated to exceed 1.5 billion euro. So this kind of losses, of course, put on the table the how agriculture is able to face and to manage these kind of catastrophic claims from farmers. So this is one of the most challenging tasks that Italian government need to tackle for the future, considering also that if we look at the risk assessment scenario current and looking at 2050, we have also for Italy a huge increase in the damages exposure for farmers, and in this context we need to overcome the high concentration in portfolio pooling for crop insurance. As we emphasized before, 80% of the value insured in Italy is located in the regional part of the country, and under current conditions, Agriculture Fund could in future maybe provide a substantial proportion of prearranged compensation for crop losses. This means that despite the low insurance penetration rate, the overall estimated protection gap for primary peril is similar to other member states. So the European agricultural insurance market in overall is characterized by major regional, technological, cultural, and economic differences. So each country has created and developed its agricultural insurance market in a distinct way, adapting them in a combined response to local circumstances in the EU policy. So the overall result is a diverse spectrum of insurance system across the EU, with a trend towards greater harmonization. Member states such as Spain, Austria, France, Italy are a well-established agriculture insurance market with government subsidy and private sector involvement. In other member states, the market is still developing, and the range of insurance solutions on offer is very limited. The CAP 2023-2029 framework at this moment include expanded risk management support, but uptake remain very limited. Historically, insurance-related expenditure accounted for less 100% of the CAP budget, approximately 2.5 billion of euro in 2016. It's a stark contrast to the United States, where 60% of the Farm Bill budget is allocated to insurance, and our for tools aimed to stabilize farmers' revenues. So the big challenges for the future could be identified in the low insurance penetration rate. So the insurance penetration rate remains a significant challenge across the EU, with availability, affordability, and administrative complexity being major barriers. In many countries, as we emphasized just a few moments ago, key barriers such as drought remain uninsurance, so limiting farmers' ability to manage risk effectively. Several systemic risks also persist. Adverse selection is a concern, but as limited participation means those with the highest risk are more likely to see coverage, leading to unsustainable insurance pools. Unmanaged catastrophe exposure presents another challenge, as many member states lack clear framework for handling extremist loss event without relying on unbudgeted emergency support from national governments or from the EU. Furthermore, the level of adaptation effort to increasing climate risk remain uncertain, and many systems lack long-term strategy to balance affordability and sustainability. So some recommendation on these fields: science and insurance align the risk modeling. So recommendation acknowledge the fundamental importance and dependence on insurance aligned risk modeling metrics, as after 30 years of adoption by the insurance sector, wider risk capital markets and deregulation, as well as supervising the EU and beyond. So this methodology should provide proven, practical, and consistent basis for policy making and operational decision making implementation. For risk layering, the recommendation follow the risk framework of attritional, major, and catastrophic losses applied throughout the RAP. So we introduced that design sustainable risk sharing system and insurance-based risk management should be adopted to guide complementary adaptation and resilience intervention. We need a very consistent public and private risk sharing in European country, and we have to increase the effectiveness of a sustainable insurance system that should be based on optimal understanding and evaluation of current and future risk.